In today's tax meeting, we'll be talking about how to actually calculate top-up tax. So we'll be looking at the middle three pieces of the jigsaw. Firstly, we'll talk about how to allocate income and taxes between constituent entities in an MNE group. Secondly, we'll look at how to calculate the effective tax rate for a jurisdiction, including how much top-up tax will be payable for that jurisdiction. Finally, we'll talk about how the top-up tax should be allocated between constituent entities in the jurisdiction. So we're starting off by assigning income and taxes to entities. And the first part of this is identifying which entities are within which jurisdiction. And GloBE has a set of rules to identify where entities are located. So let's take a look at these. Opaque entities are easy. If they are tax resident, then they are located in the place that they are tax resident, and if they are not tax resident anywhere, then they are located in the place that they were created. Permanent establishments are located in the jurisdiction where the permanent establishment is. Let's look now at flow-through entities. So these are fiscally transparent entities. If they are fiscally transparent in the place where they are created and in the owner jurisdiction, then they are a tax transparent entity. And if they are fiscally transparent in the place that they were created, but not in the jurisdiction where the owners are located, then they are a reverse hybrid. So the general rule for flow-through entities is that they are stateless. However, if the flow-through entity is the ultimate parent entity, the UPE, or if the flow-through entity is required to apply the income inclusion rule, then it is regarded as being located where it is created. For other entities, stateless entities, what this means is that they are not assigned to a jurisdiction. So for these stateless entities, you would calculate their effective tax rate and their top-up tax on a standalone basis rather than combining their attributes with other entities in a jurisdiction. For dual resident entities, for example, an entity that is tax resident in the country that it was incorporated and also tax resident in the country where it is essentially managed and controlled, you would apply the tax treaty tiebreaker. If there isn't a tax treaty tiebreaker, maybe because there's no treaty, or perhaps because the treaty requires you to go through the mutual agreement procedure, then the entity is located in the jurisdiction in which the greater amount of covered taxes is paid. If the amount of covered taxes is equal in two jurisdictions, or perhaps there's no covered taxes, then the entity is located in the jurisdiction in which it has the most substance, and if it has no substance, then it is stateless. The next step is to calculate each constituent entity's GloBE income. And one starts with accounting income using the ultimate parent entity's financial standard. To this, a series of adjustments need to be made. So the first thing to do is to add back the net taxes expense. And this is made up of covered taxes, we'll come on to the meaning of that in a minute, top-up taxes, deferred tax assets, for example, if there was a loss for the year. All of these will be reflected in the tax expense shown in the accounts, and you would need to add this back. The next thing to strip out are excluded dividends. Now, dividends will be excluded unless they arise from a short-term portfolio holding. Short-term means something that has been held for less than a year, and a portfolio holding is an ownership interest that carries rights to less than 10% of profits, capital, reserves, or voting rights in an entity. And this is measured at the date that the dividend is paid. So if an entity holds an 11% interest in another entity, a dividend paid by that other entity will be an excluded dividend, even if it is held for less than a year. The next thing to be removed are excluded equity gains or losses. And these are gains or losses on the disposal of an ownership interest other than the disposal of an interest in a portfolio shareholding. Here, there's no holding period requirement. Then you need to add back any policy disallowed expenses. All bribes and kickbacks are disallowed, but Fines and penalties above the de minimis amount are also disallowed, and the de minimis amount is €50,000. Finally, any pension contributions that have been accrued but not paid need to be added back. The next thing that needs to be done is an arm's length adjustment. So transactions between constituent entities in different jurisdictions must be in line with the arm's length principle, and it must be recorded by each of the entities, each party to the transaction, at the same price. You would expect that groups of the size that are within the scope of the GloBE rules would be applying transfer pricing anyway, but issues can arise where there is a unilateral adjustment. So you might have either double taxation or double non-taxation if no corresponding adjustment was made by the other party to the transaction under the GloBE rules. You don't generally need to make any arm's length adjustments for entities within the same jurisdiction, but there are two exceptions to this rule. First exception is where there is an asset transfer between the two parties that results in a GloBE loss, and the second exception is where one or both of the entities are minority-owned entities, and this is because they need to compute their effective tax rates separately rather than being subject to jurisdictional blending. So the transaction won't sort of net out during that blending process. And then the final thing I wanted to point out, well, two things really, is that qualified refundable tax credits are treated as income. We went through the meaning of that a couple of weeks ago, and that also international shipping income is excluded. And this is the only type of income that is excluded from the GloBE rules, and it is excluded at this stage of the calculation. As well as calculating the income needs to be assigned to the constituent entities. And there are some special rules for assigning income to special types of entities. Let's start with permanent establishments. Now, there are different types of permanent establishments under the GloBE rules. There's a hierarchy in the definitions, which starts with permanent establishments that arise under a tax treaty, and then goes on to permanent establishments that arise under domestic law, and so on. The income that is allocated to the permanent establishment is the income that is allocated to it in the financial accounts, but then you adjust that income by reference to the relevant profit attribution rules. So if the permanent establishment has arisen under a tax treaty, then you would look to the profit attribution rules in the tax treaty. Likewise, if it has arisen under domestic law, then you would look to the profit attribution rules under the relevant domestic law. Looking now at tax transparent entities, the general rule is that you allocate the tax transparent entity's income to its constituent entity owners in proportion to their ownership interests. However, if the tax transparent entity is the ultimate parent entity at the top of the group, then you need to allocate the income to the tax transparent entity itself, but apply the special rules that we talked about a few weeks ago in doing so. And finally, reverse hybrids. This is an entity that is transparent in the entity jurisdiction but opaque in the owner jurisdiction. You would allocate the income to the reverse hybrid, not to the owner. The next step is to calculate each constituent entity's adjusted covered taxes. I've set the definition of covered taxes out to the right of the slide, but broadly you're looking for tax on income and profits. So the starting point in doing this calculation is the current tax expense in the financial statements. And the first thing to do is to strip out from that any taxes that aren't covered taxes. So covered taxes is basically tax on income and profits, and you would need to strip out from that tax expense other sorts of taxes, things like payroll taxes, so NICs, taxes on sales like VAT, transfer taxes, stamp taxes, and so on. You would also need to strip out any top-up taxes that have been charged under the GloBE rules or under domestic law. You then need to make a series of reductions. So these will be things like tax relating to uncertain tax positions, and this is where the accounts reflect the probability that a different tax treatment to that which has been adopted will be applied. And you would also need to strip out tax which is in the accounts but not actually expected to be paid in 3 years. Finally, you'll need to make a reduction for tax on income that isn't GloBE income. So you remember that we stripped out excluded equity gains and shipping income from the income a couple of minutes ago. If there is any tax included in the current tax expense on those sorts of income and gains, then that will need to be removed. Then there are some additions. The first thing that will be added is the total deferred tax adjustment account, and this is the deferred tax expense that is shown in the accounts adjusted as we discussed a couple of weeks ago, so recast at the 15% minimum tax rate. You also need to add in any covered taxes which have been recorded elsewhere in the accounts. So this might be an expense in the profit and loss computation, or it might be a movement in taxes shown in equity or other comprehensive income. Finally, you need to add in any covered taxes which were disallowed in a previous fiscal year, for example, because they related to an uncertain tax position, where this tax has now been paid in the current fiscal year. The final thing to do at step 1 is to make sure the covered taxes have been allocated to the correct entity. Now, in most cases, this will be the entity in whose accounts the tax expense is shown. However, there are some special rules for special types of entities. And I think the thing to remember here is that in general, the allocation of tax should follow the income allocation. And this makes sense because if this doesn't happen, then what you will have is income in one entity and taxes elsewhere, meaning that the entity with the income is regarded as undertaxed and that top-up tax is due. So going through different types of tax, we have got taxes on GloBE income that is attributed to a permanent establishment. That tax will be allocated to the permanent establishment because that is the entity that has the income. Taxes in a tax transparent entities accounts on income which is allocated to a constituent entity owner, that goes to the constituent entity owner because it's the owner that is allocated the income. Taxes that are levied under a controlled foreign company regime in one of the parent entities, that will be allocated down to the controlled foreign company, so the company that actually earned the income. Next, we've got tax on a hybrid entity income in the constituent entity owner's accounts. That goes down to the hybrid entity. So for example here, if we've got a UK company with a US parent, UK company has made a check the box election, so it's regarded as transparent or disregarded for US tax purposes, but it is opaque for UK tax purposes. That sort of entity would be a hybrid entity. And if there is US tax on that entity's income, then it gets attributed down to the UK entity. Tax on distributions in the constituent entity owner's accounts. So this actually gets allocated down to the distributing entity. And the sort of rationale behind this is that it's the distributing entity that has earned the profits out of which the distribution is made, and when those profits in the form of a distribution hit the constituent entity owner's accounts, there shouldn't be any they shouldn't be GloBE income because they should be an excluded dividend. So for that reason, any tax on that gets sent down to the distributing entity. And then finally, withholding taxes. So withholding taxes levied on interest or royalty payments, for example, would be attributed to the entity that earns the income. So that's going to be the recipient of the interest payment or the royalty payment. Now that we have allocated income and taxes to the constituent entities, the next step is to calculate the effective tax rate. Now this is done on a jurisdictional basis. So you add together the GloBE income, or indeed losses, for the constituent entities in the jurisdiction, and this gives you the net GloBE income or loss. You then need to add together the adjusted covered taxes for the constituent entities in the jurisdiction. Once you've done that, you divide the aggregate adjusted covered taxes by the net GloBE income. The effective tax rate of minority-owned constituent entities and investment entities is calculated on a standalone basis, and the commentary to the rules says that that's because the income and taxes of these types of entities can have a particularly distortive effect. No effective tax rate calculation needs to be done for jurisdictions that have net GloBE losses, although you need to remember that strange rule that we covered a couple of sessions ago, where there can be top-up tax for loss-making jurisdictions where the losses are larger than expected due to a permanent difference between GloBE rules and local tax rules. Note that there is no restriction at the effective tax rate calculation stage by reference to the group's ownership interest in the constituent entity. What this means is that taxes and income that are attributable to ownership interests owned by persons outside the group are taken into account in the effective tax rate calculation. And as I said, this is done on a jurisdictional basis. So you have blending, which smooths out the calculation. An entity that might otherwise have been a low-tax constituent entity may not be when the income and taxes of other entities in the same jurisdiction are taken into account. So you can see it might be useful to have something loss-making in a jurisdiction that is low-taxed because it would reduce the overall income. Likewise, it might be useful to have an entity that pays high levels of tax to raise up the average taxes. So it might actually be advantageous for a group, for example, a farmer group that benefits from the patent box, which gives rise to a 10% rate of tax, and would otherwise be low taxed in the UK. It might be useful for that sort of group to acquire some entities in a different industry that pays UK corporation tax closer to the headline rate and use this to shelter the patent box entities from top-up tax. At the moment, there doesn't seem to be any anti-avoidance rules that would prevent you doing that. So we've calculated the effective tax rate. The final step is to actually calculate the top-up tax. And the first thing to do is calculate the top-up tax percentage. The top-up tax percentage is the minimum rate of 15% less the effective tax rate that we've just calculated. So if the effective tax rate is below the 15% minimum rate, top-up tax will be payable. However, it might be levied under domestic top-up tax, and we'll come on to what that is in a minute, meaning that no top-up tax charge would be due under the GloBE rules. If the effective tax rate is equal to or above the minimum rate, no top-up tax will be payable as a result of the current year activities. However, you might have to pay a top-up tax as a result of a prior year adjustment. The next stage is to calculate excess profit. This is a mechanism to exclude a fixed return on substantive activities in a jurisdiction. You deduct the return on substantive activities, and this is called the substance-based income exclusion, from net GloBE income to get excess profit, and then top-up taxes are levied on the excess profit. If there is no substance in the jurisdiction, or if the group has elected out, then the whole of net GloBE income will be excess profit. But if the substance-based income exclusion figure is equal to or exceeds the net GloBE income, then no top-up tax will be due in relation to current year activities. The substance-based income exclusion is made up of 5% of eligible payroll costs in a jurisdiction. Added to that is 5% of the carrying value of eligible tangible assets. So this applies by default, but you can elect out. Why would you want to elect out? It's because the cost of applying it and calculating it might outweigh the benefits in some situations. There are higher returns over the 10-year transitional period from the commencement of the rules. So the return on eligible payroll costs tapers down from 10% over that period, and the return on the carrying value of eligible tangible assets tapers down from 8% over the period. There is an issue in relation to tax transparent entities here. And the issue is that income of a non-ultimate parent entity, tax transparent entity, so tax transparent entity down lower in the group, not at the top, that entity's income is allocated to its constituent entity owners. The eligible payroll costs and eligible tangible assets can be reallocated to that owner, but only if the owner is in the same jurisdiction as the employees and the tangible assets, which may not be the case. If it can't be reallocated, then those costs and that carrying value is excluded from the substance-based computations for the MNE group. Let's look at the detail of this exclusion. We now need to look at the meaning of eligible payroll costs. So this is broadly defined. It covers salaries, bonuses, stock-based compensation, so share options and so on, medical insurance, payroll taxes, the employer's social security contributions, and so on. However, it must relate to work that is done by eligible employees in the jurisdiction. So one needs to identify the eligible employees and then work out whether or not its work has been done in the jurisdiction. Eligible employees are employees, whether they are full or part-time, of a constituent entity in the MNE group. So the employer entity could, in theory, be in another jurisdiction. It also includes independent contractors whose work is directed by the MNE group, but only if they're contracted directly or through an agency. So it can't include employees of a corporate contractor. The work needs to be done in the jurisdiction in which the entity in question is located, and this might be problematic where the employee is mobile and works in many different jurisdictions. There's some suggestion that detailed guidance on this might be covered in the implementation framework. The next thing to look at is the meaning of eligible tangible assets. So this is property, plant and equipment, natural resources that are located in the jurisdiction. It also includes leased assets, so there's no distinction here between owned assets and leased assets, and includes government licenses. So this might be something like a license allowing an entity to operate a toll road or a license to extract natural resources and so on. The assets have to be located in the jurisdiction in question. And again, this gives rise to issues with mobile assets, and particular problems with shipping containers and aircraft. Again, it's hoped that this would be addressed in the implementation framework. Note that property that is held for sale, lease or investment is excluded. So if the entity owns buildings that are rented out, those wouldn't count as eligible tangible assets. It is the carrying value of the eligible tangible assets that's taken into account, and it's the average of the carrying value across the fiscal year in question. So you take the carrying value at the start of the year and add that to the carrying value at the end of the year and divide by 2. If the asset is sold during the year, you will only get half of the carrying value, as the end carrying value is 0. Now that we've worked out how to calculate excess profit, we can go on and calculate the jurisdictional top-up tax. So you multiply the excess profit, that is the net GloBE income less the substance-based income exclusion, multiply that figure by the top-up tax percentage. Add to this any additional current top-up tax and deduct any domestic top-up tax. So, a couple of things we need to dig deeper into. what is additional current top-up tax? This is top-up tax which is due as a result of the recalculation of a prior year's effective tax rate. This will only be required where there has been an adjustment to a local tax item. So you wouldn't have to do this where there's been an error by the group. You would just use normal admin processes to correct the return and pay any additional tax. We're looking at something like a transfer pricing adjustment in relation to an earlier year. Where this happens, you'd be required to recalculate the effective tax rate and the top-up tax for the previous year, but that amount is paid as additional current top-up tax in the current year. Domestic top-up tax is additional tax levied to prevent an IIR or UTPR charge. It's not compulsory, but many jurisdictions, for example the UK, might want to adopt this in order to make sure that any top-up tax associated with UK activities goes to the UK Exchequer. It also prevents the complex undertaxed payments rule from applying. Domestic top-up tax has to be charged under a qualified domestic top-up tax to be deducted under the GloBE rules. And what this is a tax that applies to excess profits of domestic constituent entities and increases the domestic tax liability on those profits to the 15% minimum rate. Must be administered in line with intended GloBE outcomes, and it must not involve the grant of any collateral benefits, for example tax incentives, grants and so on, to effective taxpayers. Now it might be that domestic top-up tax might actually be larger than the top-up tax which is due under the GloBE rules due to slightly different calculation rules. If that is the case, you cannot reduce the jurisdictional top-up tax below zero, nor can you have a refund or a credit of top-up tax to carry forwards. Finally, having calculated the jurisdictional top-up tax, as we did on the last slide, you must allocate the jurisdictional top-up tax between constituent entities in the jurisdiction. Why do you need to do this? The reason is because the top-up tax might be paid by different entities. In the example here, if the ultimate parent entity, that's the UPE, is in a non-income inclusion rule jurisdiction, you would look instead to collect the top-up tax in the intermediate parent entity jurisdictions. So here, that's where IPE1 and IPE2 are located. So because of that, you need to split the top-up tax in between the constituent entities in the jurisdiction in question. Now, although you're allocating it to an entity, and here we'd be allocating it to the mustered entities at the bottom, these are not the entities that, or not necessarily the entities that pay the top-up tax. You'd look instead to the charging mechanisms under the income inclusion rule and the undertaxed payments rule to see which entity is actually going to pay it, and we'll be covering those in a future session. The jurisdictional top-up tax is allocated in proportion to the constituent entity's share of GloBE income for the jurisdiction. Now, it's the aggregate GloBE income of entities in the jurisdiction that have income that you are looking at. So you don't factor in losses to this calculation, and likewise, nothing will be allocated to loss-making entities in the jurisdiction. The final thing to talk through is the de minimis exclusion. And groups need to make an annual election for this to apply, as well as satisfying the two conditions. The two conditions are that the average GloBE revenue for the jurisdiction is less than 10 million euros, and that the average GloBE income or loss for the jurisdiction is less than 1 million euros. And these figures are averaged over 3 years, namely the current fiscal year and the previous 2 fiscal years. And we've talked about the meaning of GloBE income, but we've got a special new term here, GloBE revenue, and this is revenue with all the adjustments to income and profit items in Chapter 3 of the GloBE rules that we discussed earlier in relation to the calculation of GloBE income. Where the exclusion applies, the effect is that top-up tax for constituent entities in the jurisdiction is deemed to be zero. And also, there is no requirement to calculate the effective tax rate for entities in the jurisdiction. To finish, I thought we'd do a worked example to draw everything together, and I've taken a few shortcuts here in that I've already calculated the GloBE income and the covered taxes, as well as the return on eligible employees and tangible assets. The first step is to calculate the effective tax rate, and this is the aggregate adjusted covered taxes divided by net GloBE income. So we've got net GloBE income for CE1 of 2,000, add to that the net GloBE income for CE3 of 1,000, and deduct the 500 losses for CE2. That gives you a net GloBE income of 2,500. Aggregate adjusted taxes for those three entities is 180 plus 120 gives you 300. So your effective tax rate is 300 divided by 2,500, or 12%. Next step is to calculate the top-up tax percentage, and the top-up tax percentage is the minimum tax rate of 15% less the effective tax rate. We've just calculated the effective tax rate, it was 12%, so that gives you a top-up tax percentage of 3%. Next, you need to calculate the excess profit. So we've got a return on eligible payroll costs of 20 plus 10 plus 10, so that gives you 40 in total. And the return on the eligible tangible assets is 30 plus 5 plus 25, so that gives you 60. So your total substance-based income exclusion is 40 on the payroll costs and 60 on the tangible assets. That gives you 100. That figure is deducted from the net GloBE income of 2,500 to give you excess profit of 2,400. Next step is to calculate the jurisdictional top-up tax. And this is the excess profit multiplied by the top-up tax percentage. You add additional current top-up tax to that, and you deduct domestic top-up tax from that figure. Now, we don't have any additional current top-up tax or any domestic top-up tax in this example, so we just multiply the excess profit of 2,400 by the top-up tax percentage of 3%, which gives you 72 jurisdictional top-up tax. And then the final stage is to allocate that 72 jurisdictional top-up tax between the entities in the jurisdiction. And you do this by sharing it out by reference to the entity's share of the aggregate GloBE income of constituent entities in the jurisdiction that have income. So we don't include the 500 loss of CE2. So we have got aggregate GloBE income of 3,000. That's the GloBE income of CE1 of 2,000 added to the GloBE income of 1,000 for CE3. So CE1 has got 2,000 of that 3,000 aggregate GloBE income, so it is going to get 66.66% of the jurisdictional top-up tax, or 48. Don't allocate anything to CE2, that's because CE2 is loss-making. And then finally, CE3 will get 33.33% of the jurisdictional top-up tax, which gives you 24.